Okay. Um, Good afternoon, everyone, and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with Dan North, Chief Economist with Euler Hermes North America, who will be presenting on the outlook for the U.S. economy. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a Q&A at the end of the presentation. If you're looking for a copy of the slides to follow along today, they will be made available after the presentation is complete. The last item is that we will have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of information on how we can continue to make our webinars better for you. Now, Ken Frisco will give you a brief intro of our speaker.
Okay, thanks, Sharon.
You're welcome.
Okay, good afternoon, everybody. Just a little background on Dan North. He's been with Euler Hermes North America since 1996, using macroeconomic and quantitative analyses to help manage Euler's risk portfolio of more than $150 billion in annual U.S. trade transactions. As an economist, he has appeared on CNBC, Fox Business News, France 24, and Bloomberg Radio and Television. He has been quoted by Barron's, Business Week, Paris Le Monde, Tokyo Nikkei, the BBC, the New York Times, and the Wall Street Journal. After having predicted the 2008-2009 recession and its implications accurately, he was ranked fourth on Bloomberg's list of 65 top economic forecasters in 2010. Dan also holds an MBA from the Wharton School of Business. At this point, I'll turn the presentation back to Dan to begin our webinar.
Thank you very much, Ken. I certainly appreciate the introduction, and thanks to everybody for dialing in today. I appreciate it. I'm going to speak for about 45 minutes, mostly on the U.S. economy. But before I dive in, I'd like to just tell you a little bit about who Euler Hermes is. We are the world's largest provider of trade credit insurance. And the way our insurance works is this. If you're a business that sells to other businesses on open account, that is, you ship your goods or services, you hope to get paid back in 30 or 60 days or something like that, and you run the risk that that business you sold to will go bankrupt and not be able to pay you back. And in that case, we cover you. We will pay you back and make you whole. We cover, our insurance is for non-payment or even slow payment. We have been around for over 100 years, and we're AA- rated by S&P. And I am trying, there we go. AA- rated by S&P. We've got offices in 52 countries. We're majority owned by the Allianz Group. We do insure $150 billion here in the U.S. and $1 trillion of sales globally, worldwide. Now, we do, the primary benefit is protection against non-payment, but a lot of our customers use us to expand their sales. Say they want to go into foreign markets or sell to people that they don't know. If they want to do that, they can insure with us, and we can provide information on up to 45 million companies worldwide. In other words, if you want to sell to somebody you don't know, we probably do know about them. Other benefits are that you can get improved borrowing options. Banks, if you're borrowing against your accounts receivable, banks really like it when those accounts receivable are insured. And so in that case, you can get better terms. That is very briefly what we do. Now, we are a global group. Here's our outlook for this afternoon. We're going to just look briefly at the global outlook, then we'll concentrate on the U.S., talk very briefly about Canada before we wrap up. Now, on the first slide here, here's the global outlook. And I just want to make sure this term across the top here, GDP, is understood. It's everything produced by the economy. It's gross domestic product. It's what's produced by the economy. On average, it's grown about 3.3% a year. If you look across that top row, world GDP growth, forecasting out into 2017 and 2018, I think that's going to be the 6th and 7th year in a row that world GDP growth is less than 3%, not even that 3.3%, less than 3%, principally because the developed large economies are still in a slow growth mode. For instance, the Eurozone, we forecast growing at 1.6% next year. Japan has basically been in low gear, almost zero growth for the last 20 years. We're forecasting 1% next year. Canada in 2015 was hit very badly by collapse in the oil prices. 2016 hit by wildfires, but we think it's going to be better in 2017. U.S. in 2016 was a very disappointing year, only growing 1.6%. We think it's going to get better the next couple of years, and we're clearly the best of the developed economies. But you get the real growth rates in the emerging markets down there, China and India, 6 and 7% growth rates. Overall, the developed nations and the globe as a whole are still in a slow growth mode. Now, one of the reasons is global trade has slowed down, and part of it is protectionism. We look at the chart over on the left. The green part of the bars are the volume of trade. That is the number of widgets being shipped back and forth. The orange is the price at which those widgets are being shipped back and forth. And the blue line is basically the product of those. That's just the dollar volume of what's being shipped back and forth. And you can see that in 2015, it shrank 10%, which is a pretty dramatic shrinkage. 2016, 3%. And we expect it to grow really just 4% in volume next year, still very, very tepid. And a lot of this is due to anti-globalization, anti-trade movements, and protectionism. Over on the right, you can see trade barriers are very common. There are 3 sectors where most of trade barriers are concentrated. That is chemicals, including pharmacy, energy, and agri-food. And over this time period of 2008 to 2016, you can see the number of new protectionist measures put in place by country. So protectionism is a part of the landscape and is going to be even more so, and that's going to put a damper on global trade and global growth. So that's the very, very simple picture of the globe. Let's take a closer look here at the U.S. for a minute. On the left is a chart of our broadest measure of economic health. That's growth in gross domestic product. And you can see here on the right, these spikes down are the Great Recession. When the GDP goes negative, that's conceptually when you have a recession. So you had the Great Recession here, a mild recession in the 2000s, another recession in the 90s, and back here we had a double-dip recession in the late 70s, early 80s. Now, the Great Recession was supposed to be worse. It was supposed to be different. But if you compare it to the double-dip recession, maybe it wasn't that much different. But what was different was the growth rates that came after those recessions. Look at what happened after the double-dip recession. We had growth rates of 4, 6, even 8, 10%. Very strong growth rates. And the same thing after the 90s recession. Quite common to have growth rates of 3, 4, 6, 8%. That would be almost unthinkable these days. This horizontal black line is the average you get during a recovery of 4.6%. During our recovery, this black line down here, it's only been 2.1% growth. We've even had a couple of negative quarters during this recovery. It's been the slowest recovery since World War II. And we think it's going to continue to be slow for the next year. Much better than last year, which was 1.6. We expect to see 2.4%. The question is, why was it such a weak recovery? Well, there are a lot of reasons over there on the right. It was an asset bubble that burst. That was the housing market, which caused a financial crisis. We had massive job losses to start with, so forth and so on. But down here at the bottom in bold are some factors that are still hanging on with us, that are still going to keep a lid on more rapid growth. For instance, our economy is now something like 85% services. And the service sector, while it's more stable, grows more slowly. And we have in the labor market a skills mismatch. Employers actually have a record level of job openings, but they can't find the right people to fill the jobs. We have an aging workforce, and we have very low productivity, and those things are not going to be solved very quickly. So that's why, even though we have a better outlook in many respects, we still see growth kind of being held down by those factors. So last year, as I say, was a disappointment at 1.6%, but there's been some recent developments which, again, make us feel better about next year. And those are these three things which really set a foundation for 2017. For instance, on the left, investment broke a string of 3 negative quarters. You have to have investment for an economy to grow. And after-tax corporate profits broke a string of 5 negative quarters. This is really good news because back here when you had negative investment and negative corporate profits at the same time, that's usually a pretty strong indicator of a recession. So it's a really good thing that we got out of that. And productivity, even though it's poor in the recovery, broke out of a 3/4 losing streak as well. So these three things really set us up for a stronger 2017. Other things that are helping us too are the construction sector. Construction sector was really vital to the recovery. You can see positive growth all the way through, but it took a pretty big slide last year. It looks like that slide might be over, and if that were the case, that's an extra boost to the economy as well. Manufacturing has really suffered here. Here are two measures of manufacturing. The jagged blue line is a measure of durable goods orders, and the tan line is industrial production. And you can see in the past few years, they've both really suffered down into negative territory last year. But just in the past couple months, things have turned up very dramatically. So this is a hopeful sign as well. What else is helping us? What else is looking good? Well, the housing market's looking good. Now, this chart takes a little explaining. For instance, let's look at this tan line. This is the existing home sales. And the text here says existing home sales have grown 8% yearly since the bottom. Now, 8% is a pretty rapid growth rate, so that's a very good thing. Same thing with the blue lines. Permits growing 12%, starts growing 13%. Those are very strong numbers, measures of the housing market. New home sales up 13% annually. That's great. So that is very much contributing to gross domestic product. However, there's another factor of this chart that's really important, and it shows the risk of asset bubbles being blown up by too much credit. And that's what happened to our housing market. For instance, let's look at these measures, permits and starts, the blue lines. As the housing bubble blew up, eventually it burst. And you can see that that activity plunged to way below where it was originally. Now, yes, it's come back, but look, we're only back to levels from 20 years ago. This is the risk of credit being too easy, blowing up an asset bubble, causing enormous destruction. It takes a long time to recover. And I'll show you why in particular this is important towards the end, because we're kind of seeing signs of this in Canada as well. But the point to take away here mostly is that we have had positive growth in the housing market, and that's been a boost to the economy. What else is good for 2017? Well, this blue line is a really strong indicator. This blue line is known as the Treasury yield spread. Now, the U.S. Treasury borrows money from the rest of the world every day by issuing Treasury notes of different maturities. And it turns out that the difference in the interest rates for the 10-year security and the 3-month security is actually pretty revealing. It's a pretty good leading indicator. So, for example, here, the blue line, which is 300 basis points, you might have the 10-year yielding 4% or 400 basis points, the 3-month yielding 1%, and that difference is 3%, that's 300 basis points here. Now, that blue line you can see is positive most of the time, but once in a while, the Federal Reserve drives up short-term interest rates higher than long-term rates. And that blue line, that difference becomes negative, like it does all the way over here on the left. Why do you care? Well, it turns out a negative yield spread is a very strong forecaster of a recession. So let's take a look comparing it to GDP. You can see here that in the mid-70s, that yield spread went negative. The blue line went negative, followed by a recession. The late 70s, the yield spread went negative, followed by that recession in there. Early 80s, the yield spread went negative, followed by that recession. In the 90s, the yield spread didn't have to go all the way negative, and there was a recession. 2000s, the yield spread went negative, a very mild recession in here. And in 2000, the yield spread went negative, surely forecasting the Great Recession that we went into. But look where the blue line is now, over here on the right. It's positive, and that's a really great thing, because just as surely as a negative yield spread says recession, a positive one indicates a continued recovery. In fact, we can do the same sort of trick here. Over back on the left, when that blue line goes positive, the economy, GDP, recovers. Sorry. When the blue line goes positive, there's a recovery in there. Blue line, that yield spread goes positive, there's a recovery. Yield spread positive, recovery. Yield spread positive, recovery. And the yield spread went positive, surely forecasting the recovery we're in now, and now continuing to forecast with a great deal of confidence out for 3 to 5 quarters at least that there will be continued growth. Not necessarily strong growth, but it's a very strong, it gives us a great deal of confidence about that forecast. Finally, what's working for us as well is the consumer. Now, the consumer has been saying for a long time that we're very confident. That's that blue line, is overall consumer confidence. And that's at a really strong level. And within this survey, there are questions about the present situation. How do you feel about things now? That's the brown line, super strong. Green line is how do you feel about the future? Not quite as strong, but still pretty good. Consumer's been saying this for a while. The trouble is, consumer often says one thing and does another. And up until very recently, the consumer had been saying, I feel great, but I'm still not spending any money. Well, that's changing, because this morning the retail sales report came out, and it turns out that consumers over the past couple of months are starting to kick into gear. Total retail sales, that blue line, are now up 5.6% year over year. On average, that's around 6.1%, so this is pretty good. The core retail sales, which is the brown line, strips out some volatile items, so this is kind of the underlying retail sales. That's at 4% versus an average of 4.2%. That's pretty good. So finally, the consumer is starting to spend. And one of the things that the consumer is starting to spend on is cars. This is auto sales, the blue columns. Back here in the recession, we never would have thought that we'd get back to this level of auto sales of 17 million units a year. Never really anticipated that we'd get back there that fast, but that's where we are. Auto sales have been a tremendous boost to the economy, and we think it'll continue to be so because of that black line. That black line is the median age of vehicles on the road. So the fleet of cars on the road still continues to get older, and we think that'll provide plenty of demand going forward for new cars. And on top of all this good news, auto sales, retail sales, consumer confidence, productivity, profits, the yield spread, all of those good things paving the way for 2017. On top of all that now, we have Trumponomics. The basics of Trumponomics are to cut corporate taxes and income taxes, increase spending for infrastructure and military, reduce regulation, have reform for free trade and immigrations. These policies are all perceived as pro-growth and pro-inflation, but there is a risk as well. They will add to debt, and they risk a trade war. You should note that to implement these policies like a tax cut takes time. Tax reform, the tax bill itself, may not come up in Congress till later on this year. And even if it passes later on this year, it probably won't be retroactive to January 1st of 2017. It'll probably take place on January 1st of 2018, almost a year from now. So the plan for a tax cut I like a lot. the actual implementation and the process of getting more money in people's pockets is going to take a little while. Nonetheless, we have that consumer confidence that's being built as an expectation for that tax cut, and that helps. But it's going to take a little time to get the actual stuff implemented. And that's why down here we have three scenarios. The first scenario is what we call unlikely. It's the full implementation where Trump gets everything he wants, including deporting 11 million immigrants. We think that's unlikely to happen. The second scenario here is where there will be some compromise. And in the third scenario is the least likely, where he gets almost nothing for what he wants. But if we look at the central scenario, scenario 2, we do think it will add to GDP growth in 2017, but there's a risk it might subtract from GDP growth in 2018, and our central concern there is the curbs on free trade. That's really important for our growth, and he's obviously had a lot of rhetoric about renegotiating NAFTA or imposing tariffs on China. That could really be a downside. Inflation, in all cases, we think it's going to be inflationary because of increased spending. If we curb immigration, that will curb low labor cost employees, so that'll increase labor costs. And same thing with trade. That'll keep cheaper goods out, so that'll boost inflation there. So it's definitely a pro-growth agenda. Business loves it. You can see here the tan line is the S&P 500, the stock market. And that vertical line was the election. You can see since the election, the stock market has really taken off. Lots of very positive emotion in the business world. Continues to set new records. That blue line, that's that same yield spread I showed you a few charts ago that is so indicative of strong growth. You can see that yield spread took off exactly the same time, right after the election. Again, very positive. So it's perceived as pro-growth, those policies. They are pro-growth. But there's a downside to pro-growth. It turns out that, I'll show you this next chart, this pro-growth is also embraced not only by the large businesses in the S&P, but by small businesses as well. That's this National Federation of Independent Business Small Business Optimism Survey. That's that blue line there. This is how small businesses are feeling. That took a record jump last month, a record jump. It jumped more than it ever had before to what the survey takers are calling a stratospheric level. So small businesses, seeing that idea of tax cuts and reduced regulation, really love that. In fact, there's another part of the survey, that tan line, which is the percentage that says now is a good time to expand business. That's where we run into a little bit of risk, because it turns out that businesses that grow too rapidly are susceptible to bankruptcies. So this is where the news turns a little bit to the negative. Let me recap. The positives we have going for us are investment, profits, and productivity are laying a nice foundation for 2017. Construction and manufacturing are rebounding. Housing strong. Yield spread is very positive. The consumer, so important, is finally spending. We have Trumponomics coming, which is pro-growth and pro-inflation. And we have this business exuberance and this desire to expand. And that's where we run into a little bit of risk. Because as I mentioned, when businesses grow too rapidly, there's an increased risk of bankruptcies. Along with that, Trumponomics is pro-inflation. Interest rates and inflation will rise with that strong U.S. dollar, which weighs on exports. And then we have these longer-term problems of structural unemployment and low productivity and high debt that are going to kind of hold down on growth. Now, as I mentioned, it turns out that when businesses expand too fast, it puts them at a greater risk of bankruptcies. What happens is when businesses expand really fast, they start selling stuff, pushing stuff out the door faster and faster every month, but then they don't collect on the sales. They can't collect on the accounts receivable fast enough. So they're sending goods out which have a cost associated with them, but they're not getting the money back fast enough, and bang, all of a sudden they're bankrupt. And it happens more frequently than you would expect. So expect bankruptcies to rise, and in particular, this happens in a rising interest rate environment. In the chart, you can see the blue line is the yield on the 10-year Treasury. The tan is the number of bankruptcy filings, business bankruptcy filings. Very close correspondence. And we expect to see, and we've already seen over here on the right, interest rates on the way up. And the red is our forecast for business bankruptcies. So rising interest rates, perhaps overexuberance and too rapid an expansion cause a risk of increased bankruptcies. Now, we think that this interest rates are going to continue to rise for a couple reasons. One is the Federal Reserve is always late to the party. Now, what this chart shows is the brown is inflation, consumer price index. And the blue line is the Federal Reserve Fed funds rate. And basically, when they see inflation, they start raising that rate. But in almost every case, you can see starting off on the left, they raise the rate here and then have to chase inflation. That is the brown. They raise rates here, starting to raise rates and chase inflation all the way over to here. Raise rates here, start to chase inflation. On average, they're chasing inflation for 31 months. So the point is, once they start raising rates, which they started last December, they're probably going to be chasing inflation. Over here on the right, you can actually start to see it develop. We think that the Fed's going to raise twice this year, maybe even 3 times, because inflation is here already. Here are some different measures of inflation. Here's consumer price index, the core index, which strips out energy and food, PPI is the producer prices. You can see that all of those measures are pretty rapidly coming up to this Fed target rate of 2% inflation. In fact, the consumer price index came out this morning. It's well above 2%. It's close to 2.5% now. Other measures of inflation, well, here are wages, the blue line, clearly on an uptrend, even though there was a dip last month. This measure is what we call PCE core inflation. This is one of the Fed's favorite measures, also on an uptrend. The blue line over on the right, all the way to the right, is commodity prices, up 15% year over year, rapid increase. And this tan line is what we call a tip spread. It's basically a measure of inflation expectations. You can see that's on the way up as well. Inflation is already here, and we think the Fed's going to be chasing it. Interest rates are going to rise. Because the Fed is raising rates and interest rates are rising, it makes our U.S. dollar more attractive compared to other currencies. Now, each line on this chart is the dollar versus another currency. And when these lines are going upward, it basically means the U.S. dollar is getting stronger. Well, the black line is the average over this period. And on average, since the middle of 2014, the U.S. dollar has appreciated 25% against global currencies. That's a pretty big move. And you can see how it starts here. QE was when the Federal Reserve was making printing money, basically. And here's where it stopped, basically. It was like it's similar in effect to raising interest rates. And that made the dollar more attractive. The dollar started going up. And in 2015, the chair of the Federal Reserve basically said, we're going to raise rates this year. And that made the dollar start going up. And then China devaluated its currency here, and that made the dollar keep going up. And then in Brexit here, you can see the dollar against the red line is the British pound. That's uncertainty, which makes the dollar more attractive. And you can see that all along through these events, the dollar has kept creeping up. Interesting in particular to note against how much it's gone up against the Mexican peso. I think it's over 15% in the last year. And you can look at the other numbers as well. Even the Chinese yuan were up 11% against the yuan. So the dollar has continued to get stronger. We think it probably will continue to get stronger a little bit just because rates look like they're on the way up here. Now, many of the trade groups that we speak to really hate a strong U.S. dollar for a couple reasons. One, if you're an exporter, a strong dollar makes your goods more expensive and it makes it harder to compete overseas. And if you're a competitor against imports, say for instance in the metal industry, you got a strong dollar, that means that foreigners can send in really cheap metal, really cheap steel, and you've got to compete against that. So there are several groups that really hate a stronger dollar. But a stronger currency merely shifts burdens between groups. The overall macro effect is kind of a wash, and here's what I mean. So we have a stronger dollar. On the left are the negatives. What makes imports cheaper, that's bad for competitors like people in the metal industry, which has to compete against cheap imported steel and other metals. On the right, makes imports cheaper, that's good for consumers who use those goods, manufacturers who use those imported goods that are cheap, that's good. On the left, makes imports cheaper, that's bad for wage earners because it holds inflation down. On the right, it's good for wage payers. On the left, a stronger dollar holds lowers commodity prices like oil. That's bad for oil producers, but it's good for oil consumers. So you see that a stronger dollar or a weaker dollar or any currency movement has offsetting effects to a large extent, particularly here in the States with the U.S. dollar. So it's certainly correct for groups that are affected to be unhappy about it. But as an overall effect on the macroeconomy, I think it's really more of a wash. Now, let's look at a couple of long-term issues that really make it hard for us to grow. These are what I call structural unemployment. The first part of structural unemployment is a plunging participation rate. The participation rate is just the percentage of the population that's actually working or wants to work. And that's really fallen off. Part of it's been due to a weak economy, but also part of it is due to the fact that 10,000 baby boomers retired today, and they're going to keep doing that for the next 11 or 12 years, and we can't replace them fast enough. Here's where more skilled legal immigration would help. This isn't the illegal immigration debate. I'm talking about skilled legal immigration, because what happens is we've got 1 million foreign students in this country. The largest single slice of them are graduate students. The largest single slice are Chinese. And the largest single slice are studying science, technology, engineering, and math. And virtually the day that they graduate, we kick them out of this country. This is a crazy system. These are the people we need to have in our workforce. What we ought to do is say to them, if you want to come study here, that's great. We'd love to have you. But then you're going to stay for 10 years. You're going to pay into our Medicare, into our Social Security. You're going to stimulate our workforce. We need more skilled legal immigration. Let me show you this participation rate dropping off so much. On the left, this chart, again, this is the percentage of the population that's either working or wants to work right now, and you can see it's dropped off dramatically. And part of that, again, due to the weak economy, but part of it is what's happening on the right, is our aging population. This chart shows the percentage of the population in different age brackets. So on the left is most bracket is the ages 15 to 24. The blue is 1990. The brown is basically now, 2014, basically now. And what the chart says that is in 1990, about 18% of the population was in this age bucket of 15 to 24, working age group. But in 2014, that was down to about 17%. In the next age bucket, in 1990, there was about 23% was in that bucket. Now that's down to about 17%. So over here in the working age area, we're getting fewer and fewer people in the workforce. And on the retirement and aging part of the population is getting bigger and bigger. This is what we call the age wave, the silver tsunami, our aging population, which means that the workforce is really getting depleted by people retiring, getting out of the workforce. We need to have people fill these positions. And the second part of this is a skills mismatch. We actually have in this country a near record high job openings rate, but they can't find the right people. And we could fix this again with more skilled vocational and educational training, and again, more skilled legal immigration. I'll show you how this mismatch shows up. Here, the brown line, this is job openings and hirings. The brown line is the job openings rate. The blue line is the hiring rate. And you can see in the last year, we've had something we've never had before, which is the openings rate is higher than the hiring rate. And what it means is employers have plenty of job openings, but they can't find the people with the right skills to fill them, and that's why the hiring rate is lower. First time it's ever happened just in the past year. Because the people that have already been hired can't really, their skills don't really match, productivity has been really weak in this recovery. Here's productivity over here in our recovery. You can see it's been very low historically. Here's another way to look at it on the right. These two columns on the left are the post-World War II period. You can see that productivity grew at 2.3%. During our recovery, productivity grew at less than half that rate, only 1%. And the brown is gross domestic product, and it's no coincidence that the difference in productivity at 2.3 minus 1, 1.3%, is the same as the difference in GDP growth. You have to have productivity for an economy to grow, and it's been very, very weak in this recovery. And part of it, there are many explanations. Part of it might be we're not measuring it right, but part of it is regulation, because in the financial services industry, for instance, we now have hundreds of thousands of people that do nothing but make sure that we're complying with laws, with new regulations, and their productivity is basically zero. Whatever the explanation, our productivity is very weak, and certainly in part due to that skills mismatch. Third thing, looking forward, that makes it hard for us to grow very rapidly is our debt situation. This is the debt to GDP ratio. You know, we have $19 trillion worth of debt. That's very hard to understand how much that is until you compare it to the size of the economy, gross domestic product. Then you start to see some patterns. So here back in the 60s, the amount of debt compared to the size of the economy was 45%, 40, 30, 50, so forth, until we got to the financial crisis, and the debt to GDP ratio rose to 100%. Now, the trouble with 100% is that it slows growth. But the biggest concern to me on this chart isn't 100%. It's the number down in the lower right-hand corner, 2025. Because you see, this is the plan that's in place right now. It's not a plan, really. It's just what the Congressional Budget Office thinks is going to happen if nothing else changes. The debt to GDP ratio is going to stay at 100% for the foreseeable future. And why is that? Why can't we cut this debt? Well, here's why. Here are budget expenditures for 2015. That first piece of pie is health care. That's Medicare, Medicaid, and literally dozens of other health care programs. And that kind of spending is known as mandatory spending or entitlement spending. Mandatory spending means that it will be spent. It's in the books as being spent already. It's on autopilot unless you change those programs, unless you change those laws. Even when we have a government shutdown, this is on autopilot. Social Security, that next piece of pie, that's mandatory spending or entitlement spending. Income security, which is welfare, that's mandatory spending. Interest on the debt, I'd call that mandatory spending. Most people think a large part of the defense budget is probably mandatory spending. So our budget is about 3/4 mandatory spending. It's interesting to note that the rest of the federal government lives in this 12% piece of pie, the discretionary spending. That's where all the rest of the government lives. Most of our government budget is mandatory or entitlement spending, simply passing money from one group of people to another. And that's why some economists joke that the U.S. economy, the U.S. government, is basically an insurance company with an army, because most of what we spend is insurance payments. So how do we get this debt down if this is our budget situation? Well, I'm going to show you how big the deficit is. That's that white piece of pie. That's how much we overspend every year. So if you want to cut the deficit to get rid of the debt, what it means is if you can't touch these entitlement programs, you want to cut the deficit, you've got to cut out about half the entire federal government and a big part of the Defense Department, and that's never, ever going to happen. If you want to manage the budget, get the debt level down, you have to have entitlement reform. In fact, entitlement spending is going to be one of the biggest issues for our time, because what's going to happen is one generation is not going to get all the benefits they think. The next generation is going to be taxed to exhaustion to try to provide them. In 2030, Medicare says, well, we can only pay 85% of our claims. And in 2034, Social Security says, we can only pay 77% of what you thought. In other words, if you were expecting to get $100 from Social Security this month, by the time we get to 2034, you're getting $77. You're not getting everything you were supposed to. And that's when people realize that entitlement reform has to happen. And it's important to note that the Trump plan actually ramps up the debt and contributes to this problem. It's not hopeless. It isn't hopeless. It can be fixed. The math is simple. Just pour more money in and less out of these programs. And again, here's where skilled legal immigration could help. Right now, there's just no interest or political will to fix it. Yes, we can go on for quite a while with deficit and debts, but it really would be wise to try and fix it while we can. Though it's working against us as well. Now, let me just talk about Canada for a minute, and then I'll review everything, because Canada is interesting. It's actually a really resilient economy despite a collapse in oil prices upon which Canada is pretty dependent. Gross domestic product has actually been outside of the energy sector pretty steady. That's that tan line. That's the economy without energy prices. Pretty steady, growing 1.4%. Here's the blue line, the energy sector. You can see absolutely collapsed with oil prices. And then there were these wildfires in the oil-producing region last year. Energy sector collapsed some more, but now there's a strong rebound. Similarly, if you look at gross domestic product in terms of goods and services, services very stable at 2%. Goods, again, on a rebound. So the economy's been really very resilient. And the labor market's pretty strong, too. Look, their unemployment rate now is historically pretty low. And their participation rate, unlike us, their participation rate is historically pretty good. So their labor market is pretty strong as well. And there are a number of other measures. But I want to show you the most interesting factor of the Canadian economy, and that's a huge risk that's standing there. And that's the housing market. Here are growth rates in housing prices over the last year. In Vancouver, Canada, housing prices grew 23% in the last year. In Toronto, they grew 17%, Hamilton 15%. Those are record high rates. On average, Canada, the big cities should grow 6.4%. They grew 12%. This is the risk of a bubble, particularly in Vancouver. Again, in Vancouver, prices rose 23% last year. That's the equivalent of 1,000 Canadian dollars every day that prices are rising. What's happening is Chinese investors are basically parking money offshore, driving up prices. Here are some examples of houses in Vancouver that go 1.6 million Canadian dollars, or over 2 million Canadian dollars. On the right is a map of Vancouver. In 2010, the red is the number of houses over $1 million. Look at it down in 2016. How much of the percentage of the housing market is now over $1 million? This is basically a bubble. Now, the trouble with the bubble, like in our housing market, when it bursts, it's disastrous. So the government has recognized this and is trying to make measures to slow down the housing market. Again, it's the right thing to do, because having to pop a bubble later is disastrous. Now, in Vancouver in August, they imposed a 15% tax on foreign buyers. In October, they put in some new nationwide measures to slow the housing market. And it's too early to tell, but it seems like these measures are effective so far. Over on the right is the chart in the growth rate and prices by the most recent months. The tan is Canada. That's the first 3-month decline in prices in 4 years in Vancouver. And the blue is Canada nationwide. You can see price growth has cooled off dramatically. They're doing the right thing by slowing the housing market. The trick is to slow it slowly enough without popping that bursting bubble. And this is the biggest risk to the Canadian economy that's otherwise resilient. Let me just wrap up here. On the left, talking about the U.S., the positives are investment, profits, and productivity are laying on a good path for 2017. Construction and manufacturing is rebounding, housing strong, good yield spread, the consumer is finally on board, Trumponomics is pro-growth, and we have business exuberance and desire to expand, which leads over to the negative, where we're likely to have increased bankruptcies, the pro-inflation aspects of Trumponomics, which will drive up rates, strong dollar, which will weigh on exports, and then those long-term problems of structural unemployment, low productivity, and debt. Well, how do you fix this? How do you get higher than that forecast of 2.4%? Well, we've been saying these same prescriptions for quite a while now. Lower corporate taxes or give a holiday, broaden the tax base and eliminate subsidies, reduce regulations. Those are all things that Trump has come in and said, that's what we want to do. What he hasn't said, which is the downside, is entitlement reform. He's making entitlements worse, increasing debt, nixing trade agreements, almost certainly not encouraging immigration, and it looks like political compromise is going to be very tough as well. So that's why we think, even though that the conditions look good for 2017, there's still a little bit of a lid on growth. And in Canada, a resilient economy, but with that risk of the housing market there. That's our basic look at the North American economy. We have lots of other research on our website here, eulerhermes.us. Got a number of other publications that are all free, and I would invite you to go take a look at them. Thank you very much for tuning in today, and at this point I will take questions.
Okay, Dan, there is one question that was posted by Glenn. He says, "Hi, Dan. Thanks for an excellent presentation. Why do you like the planned tax cuts if they will increase the U.S. debt level and be inflationary? And isn't the level of U.S. national debt nearing a point of crisis?"
Okay, so this is absolutely the trade-off. A tax cut, both corporate and income tax cuts, I think will be stimulative to the economy. I think when you put more money back in people's pockets, they spend it in a way that stimulates the economy more than the government would. Same thing with corporate, particularly with corporate income taxes. If we lower the rate and change the system, we will bring back a flood of money from overseas. Corporations are holding monies overseas because of the tax system here. And if that were the case, you'd get a huge surge in investment, which would boost the economy as well. That's why those are good things. But you also note the downside. There is no free lunch in economics. I think we need some growth, and I think that money back in corporate hands and consumers is a good thing. But you're right. There is the downside that it's likely to increase debt. Now, the offset to that is, okay, let's say you cut taxes, cut tax rates, you should get less tax revenue. But if you stimulate the economy, you get more income to tax. So there could really be an offset. But you're right. What we anticipate is that tax cuts will widen the deficit, which will increase a debt. Now, that's something I don't really like either. However, I wouldn't say we're at a crisis level. Japan, for instance, has a debt-to-GDP ratio of 200%. You can run high debt levels indefinitely. It's just whether it's a good idea or not, and I don't think it is. But we're not anywhere near a type of crisis. U.S. debt, that is U.S. Treasury securities, are very, very much in demand worldwide. They're highly liquid. The U.S. is never going to default. So even though I don't like the debt and the contribution to debt, it's not at a crisis level. But your question is very good in the sense that it points out that there's no free lunch, that there are trade-offs. Were there any other questions? We've got a few minutes here if you want to submit something.
Okay, Dan, there is one more question that just came in, and this is from John. He writes, how important do you think the repatriation of taxes will be to earnings in 2017/2018?
Okay, so this gets back to the corporate tax issue. We have the world's highest corporate tax rate, and we also have a system that double taxes companies' earnings, and those are two reasons why companies don't bring money back home. It's a terrible system, and it can be changed and will be changed, and that'll be a big benefit to everybody, because all this money that's being parked offshore, a large portion of it will be brought back onshore. Now, the question is a really good one, because then what happens when corporations bring this money back onshore? What do they do with it? Hopefully, in this environment where stock prices are rising so rapidly and there's been such weak investment, they will start to use that money for what it should be used for, which is to reinvest in the company so earnings will grow. That would be a large part of the intent. And I think that will happen. However, some corporations will also use that money to pay dividends or engage in shareholder buybacks, which will boost stock prices as well. So every penny that's being held offshore isn't going to come back onshore, and all that does come back onshore isn't going to be put to use as investment. But I think a large portion of it will. I think it will grow jobs. I think it will grow earnings over the long run, and I don't see that there's really any downside to modifying the corporate tax system, which is one of the most backward systems in the world. And we still have a few minutes if anybody else wants to send a question in.
Okay, Dan, there's one more question that just came in, and it's from Kate, and she writes, wondering if oil and gas, wondering if oil and gas has leveled off, or will the price per barrel raise this year? Tough question, and maybe we need a crystal ball for this. Any indicators to measure this?
Okay, oil prices. People like to ask about oil prices, understandably so, because it has such a large effect on the global economy. Unfortunately, my point of view as a macroeconomist and looking at all the evidence is that trying to forecast oil prices usually is a bit of a fool's errand, and here's why. Prices of any good, in general, will respond to supply and demand over the long term. But in terms of oil, like other commodities, there are also very short-term effects that can't be forecast, that will really, they can't be predicted, so it really throws off forecasts. Things like fear of supply disruption, say a pipe burst somewhere, well, that can drive oil prices up. Or weather, that can drive oil prices up or down, or the value of the U.S. dollar, that can drive prices up or down, or investor sentiment or trader sentiment, inflation, or another thing that can happen is technological change like fracking, or things like this, and we've seen this a lot in the past year or so. Oh, there's a rumor that the Russians and some people of OPEC are going to get together this weekend, and cut production. Well, you hear this rumor and prices will go up, but it turns out to be a rumor, and then they'll go back down on Monday. And we've seen this several times. So the point is, oil prices can be driven by very short-term factors that are unpredictable, and can, in particular, be driven by human emotion like a lot of asset prices, which is unpredictable. So that's a long way of saying I think oil price forecasts are kind of worth what you get there. All that said, I will say I think there's one big sort of overriding factor here, which is that technology has basically opened up such a huge new supply of oil that I think it's going to be very hard for demand to outstrip it and drive prices up. In other words, all things being equal, nothing else changing, I wouldn't expect to see oil prices really accelerate a lot this year.
Okay, I believe that's it for the questions today. We're running out of time. It is 2 o'clock. If anyone does have any questions, I will provide Dan's email when I send the PDF version of the presentation later today, and you can follow up directly. With that, we are going to close today's webinar. I would like to thank Dan for taking the time to present to our group today, and thank all of today's attendees for taking time out of their day to join us. Thank you all again, and we look forward to seeing you at our next webinar.
Thanks, everybody. Bye-bye.
Thank
Bye-bye.
you. Bye-bye.